Hello everyone and welcome to my channel. In this video, we're going to talk about one of the most intriguing tech companies that has been trading on the Nasdaq, Canoo Inc., trading under the ticker symbol GOEV. It has been one of the rising stars of the 2020 era, when the EV seemed to be on the verge of taking over the universe. Of course, this is not how things eventually played out, and today people are still wondering whether there is any possibility for Canoo to recover to its former glories. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and to subscribe to my channel. Canoo is currently trading at around 26 cents, reflecting a 6% decrease over the past 5 days, a 11% decrease over the past month, and 50% decline over the past 6 months. Notably, the stock reached its bottom 3 times around the 23 cents level on November 9th, December 13th, and November 26th. Canoo has undergone a notable journey transitioning from a research and development phase to the actual production and sales phase. The pivotal question for investors is if Canoo is viable in 2024. Considering its nearly 99% nosedive over the past few years. Canoo recently entered the revenue generation phase, accelerating efforts to deliver a first few batch of units, and they have signed a 1,000 unit agreement with the state of Oklahoma. Now, when we pay closer attention, it says up to 1,000 units in a small caveat, which is a very common tactic for the EV industry in order to attract attention, with investors who don't pay attention to those kinds of details. To secure its financial position, Canoo opted to raise $45 million in preferred shares and warrant subscriptions. The move turned out to be crucial, as despite raising over $1 billion from the investors, the company found itself with only $8 million left. The injection brought their cash to around $53 million as of September the 30th, averting a potential cash crisis. Now, let's delve into the numbers. Canoo stock has experienced a substantial 98.63% drop from the 2021 peak. In the most recent quarter, the company incurred a burn rate of $81.9 million per quarter, a significant improvement from the worst point when losses reached around $120 million a quarter. The upcoming quarters are pivotal as Canoo prepare for increases in cash, aiming to mitigate the cash outflows with the increasing sales. The real excitement centers around revenue growth projections. Like the estimates currently suggest a minimum revenue of $1.4 million in 2023, $268 million in 2024, and $1.25 billion in 2025. So those figures, if they were realized or anywhere close to it, could position Canoo as a very attractive investment option. However, the journey in those 3 targets are very difficult, given the challenges faced by many new EV companies in production and delivery. Despite optimistic revenue forecasts, analysts do predict a loss of 41 cents per share in 2024, improving to a 20 cents loss per share in fiscal 2025. The gross profit margin expects to be 4.4% in 2025, signaling a step towards profitability. It's very important to bear in mind that Canoo is in the early phase of development, requiring patience as it navigates the complexities of the EV industry. Scrutinizing the balance sheet, Canoo holds currently around $56 million, and it burns more than that per quarter. So really, the financial position is uncertain, and significant shareholders dilution seems to be an option. which has already been the case in the past. With that being said, here are the technicals. Trading volume is currently around 31 million shares compared to an average volume of 35 million shares. The previous 52 weeks period has seen the stock fluctuating between 22 cents and $1.47. The volume of shares traded tells us how many shares have been bought and sold at any point in time, and if there's enough liquidity to support a trading strategy. If the flow is very thin, it's easy to enter and to push around the price, but hard to exit. When we compare the current volume against the average volume, there might be the possibility for a stock reversal or a breakthrough. So, the market cap of Canoo is currently around $190 million. As we compare the current price to the historical price fluctuations, the stock is 13% higher than the 1-month low, 17% higher than the 3-month low, and 17% higher than the 52 weeks low. On the options market, which often has a hint about where the market sentiment lies, the implied volatility is around 234% versus a historical volatility of 97%. The put-call volume ratio currently indicates 1% of put, which is already higher than what it truly deserves, as many institutional investors hedge their long positions with put options. The most recent volume of options traded is 2.8 thousand contracts, compared to the 30-day average of 3.6 thousand contracts. As for the open interest, the most recent volume of open interest is around 450,000 contracts, compared to the 30-day average of 433,000. In terms of the shareholder structure, institutional owners hold 11% of the outstanding shares. The biggest shareholders include Vanguard, BlackRock, and Citigroup. Typically, it's always good to see some institutional participation when holding a stock long term, because it offers a layer of stability and token of reliability in the medium to long term. It means that the market somehow believes that the company will be able to fulfill their promises. I personally believe that this threshold should be around 30% if you do consider long-term holding. With a current short interest of around 19%, I do believe that there is a little bit of an argument for the presence of a short squeeze, but I think that at the moment there are actual fundamental reasons allowing different people to short GOEV. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and decline quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, The central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflations. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So, really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions. While there are several reasons to consider adding Canoo to your portfolio, the long-term holding doesn't seem to be one of them at the moment if the goal is to incorporate limited exposure to the more speculative side of the EV market. Canoo could potentially meet your requirements, but if you're seeking a safer and more sustainable option, I'm sure that there are more numerous choices with better outlook and more stable returns. I would recommend to come in overall between 0.5 to 1% of your portfolio in Canoo and to split the allocation in batches of 20% at a time over the next 3 to 6 months.